Hi everyone, thanks for stopping by and seeing what I'm up to. This is my new webcam. I'm loving the wide lens. I don't like you guys seeing my little Massimo, but we will go with that. I wonder what just happened. That looks better. I hate the reflection on my glasses, and I've been reading tips and hints and things to use, but nothing's working so far. Anyway, I'm bringing you news from Kevin, so this is my intro video. Dun dun dun! Actually, my phone is here. Let's play you a song I made on an app. It's called Auto Rap. You heard me right. I'm a white girl. I don't rap. I wish I could. Certain things. But let's see. Things that I have recent, trending. Oh, about me. My beats. Oh no. Nikki D 10. Okay, you ready? So like I made a couple of these and they were going to be like an intro song, and since no one answered me last time, I'm play 3 songs and it would be like in the beginning, my little intro. It's very short. They're 15, I think, seconds each. But anyway, here we go. Okay, so that was to We Don't Talk Anymore beat, and that was my words. Let's try, this is What Is Love, and Silky Feather YouTube channel. Okay, here we go. Oh, I didn't.
Welcome to Silky Feather channel. I do reviews, so you don't have to like and subscribe. Hit that bell and more. Thank you for watching. Welcome to Silky Feather channel. I do reviews, so you don't have to like and subscribe. Hit that bell and more. Thank you for watching.
Okay, and now that was to What Is Love. Now, Work From Home is another one. Now, I liked the beat so much, and I was choosing between my channel names at the time. So if I don't hit the right one, one's for Chat with Aunt Nikki, and then I changed it to my gamers tag, which is Silky Feather. Anyway.
YouTube channel. Welcome to Silky Feathers YouTube channel. Be angry. This story's all about me. Be angry. The story is all about me. Silky Feathers channel. Like and subscribe.
I don't know why that one says angry. Hold on. I don't like that one. Maybe it's this one. So sorry, guys.
Welcome to Aunt Nikki's channel.
Oh, that was Aunt Nikki. Here it is.
I do reviews, so you don't have to like and subscribe. Hit that bell or more. I will teach you tips and tricks and know-hows and what not to do, where to buy and where to sell. Make that money. Welcome and thank you for watching. So keep on.
I think I like that one. So it would be like a little song in the beginning. But anyway, I'm sharing. Get on with the news already. All right, on to the news. I'll be in the corner watching. Bye. Like, subscribe, and share. This is Silky, signing off.
Hey everyone, Meet Kevin here. I wanted to talk to you about a new potential form of stimulus from the Federal Reserve that could not only affect our money, but also the entire economy. Have you ever heard of a market melt-up? Well, this morning, CNBC contributors on live TV suggested that it's possible we might be seeing something called a liquidity melt-up, and that got me thinking. So for the past few hours, I've been researching this, and I wanted to give you my bottom lines on the possibility of a melt-up. The easiest way to picture a liquidity melt-up is basically picture this. A firefighter whose name is Jerome Powell, with a really big hose and a lot of water coming out of the hose. The water represents money, and the Fed is the firefighter, right? The fire is the pandemic. All of the water going onto the house is money trying to solve the pandemic, but it's also flooding the house. And so all of a sudden, you got a lot of money in a system, the stock market, that wasn't there before. And then it kind of makes you wonder, are you left with a really soggy house after that? That is the economy really going to bounce back as fast as we just dumped water onto this house that was on fire? And so this is where I want to talk about the potential for this recent stock market run-up being a market melt-up and what happens after a melt-up. Are you left with normal? Are you left with a meltdown? Let's get into it. But first, remember this video is sponsored by Life Insurance, and get your 2 free stocks in the links down below. Deposit $100 with Webull, get 2 free stocks worth up to $1,400. And of course, get the life insurance that Lauren and I have. By the way, Lauren is about to post another vlog as well, so make sure to show Lauren some love. Go subscribe to her channel. So let me start by reading what Investopedia calls a market melt-up. A market melt-up is a sudden rise in the price of an asset class, stocks, due to investment by a stampede of investors interested in profiting from the gains in price. Basically, prices have started going up, so all of a sudden you get a steam of investors that come in and throw money onto those increasing prices as well. And that these investments are, quote, not indicative of fundamentals, and, quote, don't provide a picture of the health of the economy. Well, the golly, that actually sounds oddly familiar. See, we've definitely had a surge in pricing over the last 30 days, heck, even the last 60 days. Valuations are stretched, and it's starting to sound really familiar. So how the heck do you survive a market melt-up if that happens? I mean, look, it still sounds better than meltdown, but I just want to know what happens afterwards, okay? And, you know, we got to ask ourselves, is this happening? This, like, increase in pricing because, you know, the stock market is just looking out 18 months, and they're like, in 18 months, everything will be okay. No worries that millions of people have lost their job and a ton of people are on unemployment. No worries. We're looking down with, like, a telescope down 18 months down the road. Is it because corporate tax rates are cut and we're finally seeing that surge in pricing that we expected from the corporate tax cuts back in 2018? Or is this really just because Jerome Powell just doesn't turn the hose off and he just keeps watering this house that's on fire, aka running the money printer, which, remember, the money printer goes, okay, we got that. Well, the money printer, as we know, got really lubricated in March when the Federal Reserve suddenly dumped interest rates to 0. That was a shocker, right? They did that on a Sunday. I made a video that day. I'm like, what is happening? Why is the Fed coming out on a Sunday before their scheduled meeting, slicing rates? And heck, you may have even heard of negative interest rates, right? Right now we're at 0, which means the Federal Reserve's interest rates are 0, mortgage rates have come down, borrowing costs have come down, all to kind of incentivize the economy. Well, what about those negative interest rates? We know the Fed hasn't been super jazzed about those, but let me give you a quick primer in case you don't already remember about negative interest rates. Let's say you lend me $100. You're supposed to get paid interest, right? You lend me $100, so I get your $100, and I pay you $5 until that money is due back. I pay you $5 in interest every year. That'd be like 5% interest, right? Well, now what if I took $100 from you, and instead of me paying you interest, you paid me $1 every year as a thank you for holding your money? Well, that would be a form of negative interest. And the Fed has already told us, look, there's not a chance. In fact, both the Fed and the Central Bank of England have numerous times for decades, possibly even centuries, have said no. Well, the Fed hasn't been around for centuries, but the Bank of England has. Anyway, they've numerous times told us, nope, no negative interest rates. Not worth it, not happening, not for us. Too complicated, causes too many problems, too many negative implications. Basically, no way negative interest rates are going to happen. Well, at a time where we have Congress kind of stalled and their stupid sort of wait-and-see approach. Oh, let's just see how many people are really suffering, as if you can't turn on the news and see who's suffering. Anyway, take a look at what the Wall Street Journal just published regarding negative interest rates, and this is a little freaky. Here we go. This is a Wall Street Journal article about the Bank of England and the Federal Reserve. These people are like buddies. Bank of England does something, Fed's like, oh, they're doing that, maybe we should do that too. They hang with each other, okay? Fed says no negative interest rates, Central Bank of England's like, okay, no negative interest rates. Well, is that now changing? Take a look at this line right here. Pushing its policy rate below zero, aka negative, would represent another milestone in the institution's 326-year history. Officials have for years said that negative interest rates weren't an attractive option for the UK economy because banks would be forced to cut lending, strangling credit just when it's most needed. Yet, apparently, that economic fallout has not actually been proven as clearly, and maybe negative interest rates are actually an option, because take a look at what this dude here says. This dude here is Governor Andrew Bailey. He is the governor of the Bank of England. He is the money printer for England, okay? So when you think, brrr, money printer, yeah, think this guy for England. And take a look at what he just said according to the Wall Street Journal. All right, popping over here. I have changed my position a bit, Mr. Bailey told lawmakers last month when asked about sub-zero rates, not sub-zero refrigerators, like negative rates, okay? He's talking about negative rates. The policy is being looked at again as part of a regular review of the central bank's armory, he added. That's actually a really big deal. In fact, that's why the Wall Street Journal titled their article, Coronavirus Prods the UK to Consider the Once Unthinkable. Negative rates. Gosh, I feel like this is like a Halloween story. It is so weird. But take a look at this. This is where we kind of see the old stuff that we knew. Evidence of the effectiveness of negative rates is mixed. The ECB concluded in a recent study in that blah, 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 that negative rates boosted bank lending and aided economic growth. Yet in 2019, the US Treasury Department thought that negative rates in Sweden prompted banks to reduce lending rather than increase it. So you kind of have these mixed conclusions here. But even with these mixed conclusions, the futures markets in both the United States and in England indicate that negative interest rates could be a reality, even though there's tough talk, or I should say, there's been tough talk against them. Now, the Bank of England is softening their tough talk, and is the Fed to follow? And if negative rates are actually to come, what is that going to do to the market melt-up we're seeing now? Is it going to perpetuate the market melt-up? And how do we prepare ourselves? I always like to research this because I'm going to say it here, but selfishly, I like to know for my own money and my investments as well. I just like to share that with you as well because, well, I think it's the right thing to do, and I appreciate y'all so much for watching the channel and supporting and subscribing. But here's the thing. If this happens, and we see negative rates at the Bank of England, which now they're actually talking about where the governor is saying, I've changed my mind. Well, that does also mean that the Federal Reserve in the United States could just change their mind and print even more money and push us into the negative interest rate territory with the flick of a switch or the snap of a finger. Well, look, in my opinion, it's overly simplified to suggest, invest consistently and throw your money into an S&P 500 index fund. I personally don't love the S&P 500 index funds because the S&P puts more money into companies that support tobacco sales and actually sell cigarettes than they put money into companies like Starbucks or Kraft Heinz. And the S&P 500 does not include Tesla. Now, I'm not upset that the S&P doesn't include Tesla and it puts more money into cigarette companies and other companies. Whatever. It's an index fund, right? It is what it is. If I don't like that, I could pick from hundreds of other index funds. But what I suggest is that we specifically focus our attention, at least this is what I'm going to do, and don't sue me, bro, if I'm wrong or you don't like my information, but what I'm going to do is I'm specifically going to focus on investing in real estate and some choice stocks. And I'm going to bring up what those stocks are in just a moment, because I teach you how to invest in real estate and stocks in the programs linked down below. But we'll forget that for a moment. Let's think for a moment what happens when rates go negative and debt becomes really cheap. Well, companies and real estate tend to go up in value because their borrowing costs go down, which means their income is up. Borrowing costs down, income up. Makes sense. But that's not super sustainable, right? But what happens in the short term is rates go down, asset prices go up. It's like the ocean is filling up with more water because Jerome Powell's standing at the North Pole plugging into the ocean somewhere between the icebergs and is pumping in more water into the economy. Well, that's all great. I mean, we know that stocks and real estate prices go up, but what about inflation? When that dreaded I comes in, what happens then? Well, generally, when inflation happens, central banks will tend to increase interest rates to try to put a lid on inflation and push inflation back down. And higher interest rates are bad for stocks and real estate. But what's really interesting is, guess what happens when inflation occurs? Well, generally when inflation happens, you want to be in stocks and real estate. You only don't love stocks and real estate when rates are high. So in a weird way, as rates go down or negative, you want to invest in stocks and real estate. And I'll give you my suggestions in just a moment. Okay, we got that. And when inflation happens, well, you also want to be in assets like stocks or real estate, and possibly things like Bitcoin or gold, to diversify a little bit for some inflation protection, or you could invest in like TIPS, right? Treasury insured or inflation protected treasury bonds. TIPS, you could look those up. TIPS. Anyway, those are things you could invest in to protect against inflation. But in a weird way, think about it then. You're investing in stocks and real estate when rates are going down. You're investing in stocks and real estate when inflation goes up. The only time you really don't love stocks and real estate is when interest rates go up to combat that inflation. But once that inflation goes back down, interest rates tend to go back down. So in a weird way, you're usually not harmed by literally just buying and holding high quality real estate and high quality stocks. Now let's talk about high quality stocks and real estate. Quick primer. Real estate that's high quality starts with good location, population growth, low poverty. And then ideally, if you can buy a below market value deal, like how I teach you to do in my programs, you're not buying like the best new construction house on the block, the most over improved flip ever. As long as you're not buying stuff like that, and you're buying things that you could buy below market value, whether it's multifamily or single family, like I teach you in the programs below, but we talk about it on the channel here a lot, then you're insulating yourself and you're protecting yourself in real estate. Ding, that's good. We like that. What about stocks? Well, I made this very easy for you, and I'm gonna go ahead and pull it up to show it to you. But this is my M1 Finance account. And so in my M1 Finance account, I created this little index. So let's go ahead and pull it up right here. This is my current M1 Finance as of whatever today is. What is it, June 3rd? All right, this is my M1 Finance account. And you could see how I've broken down my stocks into the percentages that I like by going to metkevin.com/index. metkevin.com/index, and you will see this nice little breakdown. But this is my allocation or sort of breakdown of the stocks that I like for a potential melt up and then slow down environment. First, the safest companies are probably, at least in my opinion, during the end of a melt up, are going to be companies that Warren Buffett loves, right? The real value ones, the ones with big balance sheets and lots of cash. JP Morgan, Bank of America, Apple, Amex, Visa, Amazon, Costco. Maybe even throw in some Lowe's and Home Depot there. The companies that are probably going to get smacked are the companies that don't make a lot of money yet and are selling for massive multipliers. Those are like your Zoom, your Wayfair, potentially even your DocuSign, okay? Now, then you also have long-term trends that are going to change. I don't think the Simon Property Group, as much as I invest in them right now as a recovery stock, I don't think they're ever going to fully recover. I also don't think that the airlines are going to ever fully recover. And when I say ever, I mean, in like the next 5 years, because obviously at some point in the future, the companies will sell for higher valuations. But I don't think they're going to see that same kind of activity that we had in 2019. So in my opinion, it's probably a good idea to diversify at least into, 10 to maybe 20 different stocks, maybe more. A lot of advisors recommend you diversify into 30 plus stocks. Fine, but it's not for me because I like to read the earnings reports and I can only read so many reports. There's a lot to go through and there's a lot to read. Each of these reports are like 100 pages long and I usually read them to go to sleep because they put me to sleep. So that limits the amount of time I actually have to go through them all, but I do my best. Anyway, this is kind of the way I've allocated things right now. So you can see I've got the Tesla, the Google, the Amazon, the Apple. Tesla not necessarily being the safest from a balance sheet point of view, but it's got that growth, that long run growth that I'm looking for, where I've got more safety in my Google, Amazon, Apple. Etsy's a little bit more of kind of that long run growth plan along with Netflix. Redfin, Microsoft maybe a little bit more of a steady one. So you can see I'm trying to balance a little bit some of the old versus the new tech. But of course, this is very tech heavy here up at the front. And then I get into my more conservative positions, and these are kind of the safer ones. And because I'm 28 years old, I'm not the biggest fan of having a portfolio of only conservative stocks. And this is where I'll have my JP Morgan, Disney, AT&T, Simon Property Group, Target, and some others. You know, Peloton's also kind of like a bit of a spec stock, I'd say at this point, a little bit more tech spec, so wouldn't necessarily recommend going heavy on a speculative investment. Of course, a lot of people are going to say in their comments, come on, Kevin, Tesla's the most speculative. Yeah, that's fine. You know, go for Nikola or whatever then. So I don't know about you, but if at this point you haven't signed up for life insurance or gotten your 2 free stocks with Webull, you got to leave a comment down below and let me know why not. Also, check out my programs down below with a coupon code, and also let me know, what do you think about the market meltdown? Should we just sell everything and sit around in cash, or am I onto something here for the long run? Let me know what you think, and of course, buy and hold, folks. Buy and hold. We'll see you next time. Hey everyone, me Kevin here. We just got an update from the White House on what we might actually expect in the next round of stimulus. Now, we had talked about this, or at least touched on it yesterday, because this sort of came up through the rumor mill. It came up through the Wall Street Journal, and we're kind of like, okay, maybe that's what they're actually talking about. Now, I said in my video yesterday that, hey, you know, the Wall Street Journal tends to be pretty credible though, so we do want to pay attention to this, but I didn't spend too much time on it because it's like, it's still in the journal and it's not directly from the White House. Well, listen to what Kevin Hassett just said, and then after I play what he says, we're gonna go a little deeper here. This is fascinating, at least it is to me. I mean, that's why I make these videos, because I love this stuff. All right, here we go. This is Kevin Hassett. Listen to what he says.
As you know, that when you're in the White House, sometimes you're surprised to see that, you know, when you're having meetings and stuff, that all of a sudden you read about it in the paper. And the Wall Street Journal wrote a long article about it that seemed pretty well sourced. It was pretty accurate. And so we are absolutely meeting this week. We're going over what we think should be in the Phase 4 deal. And we're going to try to reform unemployment insurance so the factor you suggested goes away.
Okay, so that's actually really big news. When Kevin Hassett, the White House economic advisor, the dude that's in the room with Trump on every single stimulus talk, when that dude says, wow, you know, geez, that's surprising. The Wall Street Journal got that pretty dang right. They must have some pretty good sources. Well, first of all, you can't help but be jaded and wonder, was he the source? And if he's the source, that's even more deep. But we don't have to speculate on this. All we have to know is that Kevin Hassett said, wow, that's exactly what we're talking about in so many words. And now let's go back to that article and try to see if we can read between the lines a little bit more and actually just look at the black and white, because it's very helpful, and this sort of reiterates what we might expect. Because the White House, I think, as I mentioned in my video yesterday, is going to be kind of probably that prairie dog that rounds up all of Congress, because I think right now they're in so many different directions, it's just frustrating. And since apparently they only, I'm not going to go into how little they work. Stop ranting about Congress, Kevin. Okay, here's the article. White House weighs next options for stimulus bill. It's trending on the Wall Street Journal, which trending on Wall Street Journal means like nothing. But anyway, the big thing that you want to look at here is the president's team has assembled a set of proposals. This is the first thing that's really important to keep in mind, because we don't want to think it's only, you know, $450 a week back to work, or it's only the $1,200 checks. And if it's not the checks, then maybe it's something else. And if it's something else, then it's not the checks. That's not what they're saying. They've put together a set of proposals. Now, we don't know what those proposals are, other than that these proposals are to encourage the public to return to work. Okay, we got that. But it also says, and resume normal life. Well, resuming normal life for people who don't have work would probably mean, okay, how about some more, you know, potential stimulus or relief for people on Social Security? We've already heard of Lindsey Graham, a Republican, suggesting, hey, maybe we need some more support for people who are on Social Security. The cost of food has gone through the roof. It's not fair to people on Social Security. So both of these things could apply here. But then he also says, or the article says, including going out to restaurants and taking vacations. We knew that. But think about this part here in green. We've been through the rescue phase. Now we're in the transitional reopening phase, and we'd like to move into the growth incentive phase. Those are really big words here. How do you incentivize growth? You give them money. giving people money, in my opinion, based on these 2 paragraphs, is very, very important. Now, how much, what kind of check, what kind of sets of proposals, we don't have clear information on. We're going to get some hints, but this is really good. Growth incentive phase. So think about that. When you're thinking about stimulus, think they want everybody to be able to go back to normal, but they also want to incentivize growth. And just because they're mentioning restaurants and vacations doesn't mean they're not considering other things as well. But I know there was a lot of backlash about this idea about like a tax credit for going on vacations or going out to restaurants. And then it's like, well, hello, we don't have any money. Like, how are we supposed to go on vacations or to restaurants if we don't have money? And to me, I look at this and I combine these things. I go, okay, they want people to go on vacations within the United States and restaurants, and they want to incentivize growth. Well, how about you give people money to do that? It's just an interesting idea, but this article is becoming more and more important now based on Kevin Hassett reiterating, basically confirming exactly what's in here. So that's why I spent more time going back to this, and I want to share those conclusions with you. Let's go to the next page here. All right, so this was a good line. This was probably the best line of the second page here. The White House officials said they aren't trying to stall in hopes of killing the next bill. That's good, because so much of what we've heard has been, oh, it's dead on arrival, it ain't gonna happen. And that's very demotivating. So, okay, so the White House isn't trying to kill the next bill, or they're not trying to stall to kill it. Okay, interesting. Over here, let's see what we got here. The White House officials continue to bet on a V-shaped recovery. I wrote over here, election. Think about it. What do Republicans need to win the election? The V-shaped recovery. If we have a W, that is the market crashing again, that could happen around the time of a potential second wave. That could happen right around the time of the election, and that would be very, very bad. So I expect the White House to plow money at this problem to make sure we have a V-shaped recovery. Come on, Mark Cuban's idea of giving everyone $1,000 every 2 weeks if you go spend it is a brilliant proposal. That, combined with encouraging or incentivizing people to go to restaurants and going on travel and going back to work, oh my gosh, come on. Like, that would be, and I'm not trying to get political, but that would be a in-the-bag election. If they gave people money and they incentivized people to have a good time by going on vacations and going to restaurants, the election would be in the bag. And Trump has the power to do that, and we know that Trump is the kind of person who will take every possible source of leverage he can. So it's interesting to me, especially since we now have Kevin Hassett confirming this article, basically, and the content of it. Now, we know that the White House and Republicans have rejected extending the $600 a week unemployment, but they're open to maybe, or at least they're weighing the idea of extending the unemployment benefits, but maybe only you would receive, $250 to $300 a week instead. So that way people aren't getting paid more for being on unemployment. This is where we have that tourism tax deduction or credit, which again, I put a $sign next to that because look, that's cool. You could give people a tax deduction or a tax credit, but the bottom line is you actually gotta have people with money to be able to do this, to feel comfortable going on a vacation again. Hey, look, if they said, hey, Kevin, I'll give you guys a $3,000 stimulus check and you'll get a tax deduction on stuff you spend or some other tax credits, you bet I'm taking a vacation, especially if they say in the next 3 to 6 months. Bye-bye, YouTube. You guys are going to be without Kevin for a few days. I'm going on a vacation. And I'll tell you, after this whole Rona pandemic, I need it. So I don't know about you, but to me, this sounded actually really promising. And the fact that Kevin Hassett just confirmed it, I might have to cancel my life insurance. Or maybe I should just keep life insurance anyway. In case you need life insurance is available in the link down below. Get 2 free stocks with Webull when you deposit $100. Get 2 free stocks with the stock